OG, the Asian guy, is here. A Chinese billionaire just bet $300 million against silver. Bianeing, a low-profile Chinese trader who made nearly $3 billion from bullish gold trades, just placed the Shanghai Futures Exchange's largest net short bet on silver, now worth about $300 million. His short position totals roughly 450 tons, 30,000 contracts. Silver's recent 16% drop boosted his paper gains massively. But here's what's happening simultaneously, and this is where it gets critical. While this Chinese billionaire establishes his massive short position, the Trump administration convened 54 countries to address critical mineral supply chains and pricing mechanisms. J.D. Vance and Marco Rubio hosted 54 countries for a critical minerals ministerial meeting. When they use words like critical minerals, understand this is code for physical silver. President Trump is not going to allow China to corner the silver market. The global structural silver supply deficit can only be alleviated through higher prices, increased production, or decreased demand by cutting off Chinese access to Western metals. The Trump administration just fired all 3 silver weapons at China simultaneously. Current prices, as I'm recording, silver Western spot $70, Shanghai spot $81, Shanghai futures $19, Shanghai premium $11, gold for $800 Before we move on, I've received comments and messages asking why I called out that 87 to 90 zone as resistance on the paper market. And look, we saw 3 rejections there. Price has now pulled back to around $71. Tone shift, direct, no nonsense. So if you'd like me to cover the technicals in detail, comment below. We can definitely dive into that occasionally, though not in every video. For long-term investors and physical stackers, I'll say it again, this is pure noise. But if you're trading paper, listen up. I've said it 100 times. If you're over-leveraged, sizing too big, and trading without a plan, these markets will eat you alive. You need a solid strategy and ironclad risk management, especially trading with leverage in these volatile conditions. Market analysis, building tension. Look around. Everything's dumping right now. Stocks, crypto, metals, everything. If you're really here to learn and you're finding value in what we do, hit subscribe, drop a comment with OG Te Asian Guy, and let me know. Should we break down these technicals in detail? Not every video, but when it matters. At the ministerial meeting, J.D. Vance emphasized that despite focus on digital and tech economies, real physical commodities remain fundamental. He noted the room represented roughly 2/3 of global GDP and stressed the need for greater independence and self-reliance in critical minerals. He then addressed current market conditions, stating that international critical minerals markets are failing to create sustainable domestic industries or secure supply chains. He pointed to concentrated supply chains and persistently suppressed commodity prices, influenced by forces outside individual nations' control. He acknowledged that mining projects frequently stall and fail due to erratic, unpredictable pricing that makes consistent investment nearly impossible. The stated goal is to stabilize pricing to enable domestic supply chain development. The revelation, increasing intensity. The implication is crystal clear. The U.S. government recognizes artificial price suppression in critical minerals markets and is working to address it through policy. This represents official acknowledgement at the highest levels that current market pricing mechanisms are dysfunctional and require intervention to support strategic domestic production. Now, let's talk physical reality. Australian bullion dealer Citigold halts silver sales due to global silver shortage. Retail sales temporarily pause due to global silver shortage, not temporary demand spike. Actual shortage forcing dealers to stop selling. India's MCX hikes silver margins 7%, gold margins 3%. Exchanges don't raise margins out of comfort. They do it out of fear. If gold were the problem, gold would be hit harder. It isn't. Silver is. High margins equal stress. Stress equals positioning risk. Building the narrative, facts rapid fire. Positioning risk equals too many traders on the wrong side. They're not protecting investors. They're protecting the system. The market is telling you what it fears, and it's not gold. COMEX silver deliveries report. Another 608 delivery notices issued Wednesday. JP Morgan issued 531, stopped 239. Total COMEX February silver deliveries rise to 3,563 contracts, 17.815 million ounces, 4 days into the non-primary delivery month. COMEX gold deliveries, 2,192 February, notices issued Wednesday. Barclays issued 134, JP Morgan stopped 740, Citigroup stopped 1,000. Total February gold notices rise to 32,040 contracts, 3.2 million ounces. Physical demand relentless. But here's the war. Silver trading nearly 80 cents per ounce in backwardation after a historic price slam. Spot silver currently trading approximately 80 cents above front month March futures, a sign of massive shortage of physical silver in the market currently. Backwardation means you pay more for silver today than 3 months from now. That only happens when physical is desperately tight and nobody wants to wait. Now the macro picture, everything crashing simultaneously. Crypto market hit record high market cap, 4.3 trillion October 6th. Today, crypto worth just 2.3 trillion, losing 2 trillion market cap in 4 months. 46% of crypto's entire value wiped out since October. Bitcoin just dropped below its 2021 all-time high. US stocks falling after weak job data. Nasdaq down 1.34%, wiping 517 billion. S&P down 1.13%, wiping 695 billion. Russell 2000 down 1.5%, losing 47 billion. Labor data, terrible. Initial jobless claims rose to 231,000 versus 212,000 expected. Layoffs increasing. January job cuts highest since 2009. Companies announced very few new hiring plans. When layoffs rise and hiring slows together, it's a leading indicator of economic weakness. Markets are pricing that risk now. US dollar dumping at its fastest pace since 1980. The dollar is now the second worst performing currency across all G10 countries. Just 1 year ago, it was the strongest. The currency war, building connection. Past 3 months, most G10 currencies gained strongly against the dollar. Australian dollar up 8%. Swedish krona up over 10%. New Zealand dollar up more than 5%. Why? Rising political uncertainty in the US, trade policy aggressive and unpredictable, tariffs imposed repeatedly. Markets pricing risk of broader trade war, creating a sell America trade where global investors reduce US exposure. Capital flows out, dollar weakens. Growing concern around Fed independence. Public pressure on the Fed to ease policy raises doubts. When markets believe political influence could push easier policy, confidence in the dollar falls. Rising concerns around US fiscal deficit. Government debt continues increasing. Large-scale spending raises long-term stability questions. Higher deficits historically put downward pressure on currency. Ongoing trade tensions reduced foreign demand for the dollar. Many countries are gradually shifting away from dollar exposure, moving capital into safe haven assets like gold and silver. The Chinese countermove, dramatic reveal. Treasury Secretary Bessant acknowledged hearing reports about China developing digital assets backed by physical commodities rather than the renminbi, specifically for international payments and reserve purposes. Meanwhile, China's documented actions show a clear pattern. Gold reserves have reached all-time highs at 74.1 million ounces, while U.S. Treasury holdings dropped to 682.6 billion, the lowest in 18 years. China has reduced its Treasury position by over 600 billion since the 2013 peak, while simultaneously doubling its gold reserves. The shift from dollar-denominated assets into physical commodities is measurable and ongoing. Every asset on Earth is crashing at the same time. That doesn't happen in free markets. It only happens under extreme manipulation. Market mechanics, technical but accessible. Precious metals. Market amidst a fight between banksters, still shorting gold and especially silver and overwhelming global physical demand. The precious metals market continues to show dysfunction between paper pricing and physical fundamentals. The coordinated smash of derivatives in silver and other critical minerals was timed right before this critical 54-country meeting. We are witnessing a coordinated worldwide reset in critical minerals, from discovery to market into production. This wasn't some random meeting hosted by J.D. Vance and Marco Rubio. It wasn't just table setting for trade deals. It was planned and coordinated. No doubt, a coordinated smash of derivatives timed right before the critical meeting. While Chinese billionaire Bianeing shorts 300 million paper silver, the Trump administration is establishing a price floor system and restructuring the entire global critical minerals market. When sentiment becomes excessively bullish, buyer exhaustion can trigger pullbacks even in structurally tight markets. These corrections have occurred repeatedly since the 2022 cycle low, followed by resumption of uptrends. The current situation shows this tension clearly. Fundamental tightness is real. The physical reality, grounding. The narrative, physical shortages, dealer halts, backwardation, policy shifts towards supporting production. But short-term positioning became crowded. The Chinese billionaire's $300 million short, exchange margin hikes, and forced liquidations reflect that crowding. Technical indicators across risk assets show deeply oversold conditions similar to previous major bottoms, though oversold markets can remain oversold during deleveraging events. The contrast between collapsing paper prices and intensifying physical scarcity creates the classic divergence that defines these markets. Stock market sees most amount of fear in almost 2 months. Volatility everywhere. China and the US are now competing directly over critical minerals markets, with both sides implementing strategic policy measures. The meeting with 54 countries, the J.D. Vance statements on manipulation ending, the focus on making critical minerals markets predictable and independent from concentrated control, all of this is the counter move. While Bianeing shorts 300 million paper, the Trump administration is restructuring the entire physical market to cut off Chinese access and ensure domestic supply. 3 takeaways from this entire situation. 1, Chinese billionaire Bianeing shorts 300 million silver, 450 tons, 30,000 contracts, made $3 billion on gold, now betting big against silver, but Trump administration fires back. J.D. Vance hosts 54 countries, 2/3 global GDP. States manipulation is ending. Prices need to be predictable. Supply chains need to be independent. Price floor system coming. China will not be allowed to corner the silver market. Physical weapons, higher prices, increased production, cutting Chinese access. All 3 fired simultaneously. 2, physical shortage accelerating despite paper crash. Australian dealer halts sales due to global shortage. India raises margins 7% silver, 3% gold. Exchanges don't raise margins out of comfort. They do it out of fear. If gold were the problem, gold would be hit harder. It isn't. Silver is. High margins equal stress. Stress equals positioning risk. Positioning risk equals too many traders on wrong side. They're not protecting investors. They're protecting the system. Market is telling you what it fears, and it's not gold. The delivery data, precision and impact. 17.8 million ounces. COMEX deliveries 4 days into February, non-primary month. Silver backwardation 80 cents after historic slam. Physical desperate while paper dumps. Dollar dumping fastest since 1980. Crypto down 46%, 2 trillion wiped. Job cuts highest since 2009. Everything crashing, but physical silver disappearing. Besant confirms rumors of China gold-backed token. China dumping treasuries, doubling gold reserves. 3, coordinated smash timed before 54 country ministerial. Worldwide reset and critical minerals underway. Manipulation ending. Price floor system and restructuring entire global critical minerals market. When sentiment becomes excessively bullish, buyer exhaustion can trigger pullbacks even in structurally tight markets. These corrections have occurred repeatedly since 2022 cycle low, followed by resumption of uptrends. Current situation shows this tension clearly. Fundamental tightness is real. The warning: serious protective tone. Physical shortages, dealer halts, backwardation, policy shifts towards supporting production. But short-term positioning became crowded. Chinese billionaires $300 million short, exchange margin hikes, forced liquidations reflect that crowding. Technical indicators across risk assets show deeply oversold conditions similar to previous major bottoms. Though oversold markets can remain oversold during deleveraging events, the contrast between collapsing paper prices and intensifying physical scarcity creates the classic divergence that defines these markets. Stock market sees most fear in almost 2 months, volatility everywhere. China and US now competing directly over critical minerals markets, with both sides implementing strategic policy measures. Meeting with 54 countries, J.D. Vance statements on manipulation ending, focus on making critical minerals markets predictable and independent from concentrated control. All of this is the counter-move. Current price reality, grounding in numbers. While Bianeing shorts 300 million paper, Trump administration restructuring entire physical market to cut off Chinese access and ensure domestic supply. Current silver prices showing extreme divergence across markets. Western spot trading around $70 per ounce. Shanghai spot at $81, an $11 premium over Western prices. Shanghai futures trading at $99. This $11 to $20 premium structure shows where the real physical demand is located. Gold holding steadier at $4,808, but the silver to gold ratio tells the story. We're seeing silver undervalued relative to gold at these levels. Historically, a sign that silver is being artificially suppressed while gold reflects more accurate monetary concerns. The backwardation in silver, trading 80 cents higher for immediate delivery than for March futures, is abnormal. In normal markets, futures trade at a premium to spot because of storage costs and interest rates. When spot trades higher than futures, it signals desperate immediate demand and shortage. The macro convergence, connecting all threads. Compare this to gold, where the curve is still normal. This isn't a precious metal story, this is specifically a silver shortage story. COMEX warehouse stocks have been declining. Registered silver, the portion available for delivery, has dropped significantly over the past months. Eligible silver, held in warehouses but not available for delivery, has been getting reclassified to registered to meet delivery demand. This is not sustainable. Eventually, the warehouses run low enough that the paper market loses credibility. India's margin hikes are particularly telling. India is the world's largest silver importer. When the multi-commodity exchange raises margins by 7% on silver versus only 3% on gold, they're responding to volatility and risk specifically in the silver contract. That risk comes from the disconnect between paper pricing and physical availability. The February delivery numbers are extraordinary for a non-primary month. Typically, February sees minimal delivery activity. But we're 4 days in and already at 17.8 and 15 million ounces, 3,563 contracts. For context, that's approaching what some primary delivery months see in total. The pressure building. JP Morgan's role is notable, issuing 531 notices and stopping 239. They're both delivering silver and taking delivery. This is classic positioning for a bank that understands the physical shortage and is accumulating while also meeting obligations.